Good morning, well, good afternoon, good night, whatever time it is when you're listening to this. It's Monday, the 28th of March as I record this. Rob McGregor here, and welcome to OnTrack 2022, recorded on the 28th of March. Ironically, it's almost exactly 2 years since we recorded an OnTrack that was right at the peak of the market downturn. That was about the 24th of March in 2020. So we're now very much into our third year of COVID. And just to share, I've actually tested positive to COVID this morning. Very mild symptoms so far, touch wood. So working from home for my 7-day isolation. Jody has also tested positive as well. We were both at a conference last week in Cairns, and there's a little bit of a cluster emerging from that. Quite interesting. Everyone that's caught it there hasn't had COVID before. So those that have had COVID before didn't get it there. I'm going to talk about that a bit more, but let me just get into the usual. This podcast, this presentation is for clients of McGregor Wealth Management, particularly those that use our care investment methodology and care process. If you've stumbled upon this for any other reason, feel free to enjoy it, but please get advice to make sure anything you do is suitable to your own circumstances. I'm going to cover some of the latest economic news, put into context as always, some updates, talk through the current returns. We've got a bit happening around shares have had a rebound in the last couple of weeks. We've still got the war going on, and the number one hot topic outside the war and outside of COVID is interest rates and inflation. I'll have a look at that and some talk about property in this as well. So let's have a look at these numbers, and it's really interesting. If you look at the numbers on the right, no change in the short-term cash rate, but jump right down the bottom. All of a sudden you can get 1.65% for a one-year term deposit. Not that exciting, but a big jump from the 1% that's been sitting there solid for a long time. Now that's because bond rates have gone up. So at the top there, you can see that 10-year government bond yields are up to about 2.8%, up from 2.2%. And I'll show you some charts on this shortly. But yeah, we're starting to see some moves. Still not crazy. We've got US inflation still at no update. These numbers come out quarterly. So the Aussie and the US inflation unchanged, 3.5% Aussie, 7.5% US. So there's all the talk still about whether that is temporary or permanent and what that means. And I'll touch on that as we go through. And the Aussie dollar has snuck up a bit as well, which gives us more buying power overseas. It does put a bit of a handbrake on our international shares, and I'll touch on that. Russia, Ukraine, yeah, the war's dragging out. It's certainly not what Russia expected, or not what their leaders expected, and everyone's bunkering down, and it's hard to know how it turns out, but Russia certainly hasn't got the upper hand that I think they thought they would get, and that's leading to mounting casualties, both in damage in people and financially, both in the Ukraine, obviously, that we see, but also in Russia itself. I'll share a bit about past impact of wars again in a couple of minutes. Shares have rebounded strongly, and it's been on the back of good economic data. And you'll see this chart in the middle at the top here, and you'll see this is this is a leading indicator from Shane Oliver at AMP. So he tracks things like job ads, restaurant bookings, confidence, credit and debit card transactions to see where activity is going. You'll see the bounce in Australia after we had our lockdown in Sydney and Melbourne and the original COVID, but Australia's very much well back in spending. We certainly saw that when we were in Cairns last week. You're also seeing it from the business side, the PMIs, the Producers Manufacturing Index. So that's, the Purchasing Managers Index. So that's what corporates are buying, and you'll see they're all back into fairly healthy territory, although the US has snuck down a bit. And some really good economic activity. One of the flip sides of the sanctions to Russia from the Ukraine war is a lot of the stuff that they can't now export, Australia can. So we pick up something from there, and our economy generally going reasonably well as well. We've got COVID cases rising, and I'm just researching. I tested positive this morning, researching how I notify that. I suspect there's a lot of people that have been positive that haven't notified. So I suspect the cases are higher, but hospitalizations and deaths are certainly not moving substantially. And and I know from others that I know that have had it, for a lot of us now, it's mild. And just, I was triple boosted, and it's only probably day one for me. We'll see how it goes, but I've got relatively minor symptoms. I know there's a lot of people that get more than that. Fingers crossed for me anyway, and fingers crossed for anyone else. We're seeing the election budget will come out this week. I'll be doing a presentation, as I do every year, to the New Association of Independent Retirees. Last year we recorded that. We'll attempt to record that again and get that out to you all. But expect an election budget. Expect some spending from both sides. They're going to promise the world. The interesting thing will actually be the Reserve Bank's meeting, the next one after the budget, to see if they'll leave things as is or they'll bump up a notch. And more importantly, they may choose to wait until after the election. They often don't like to be seen to be making a call on what's happening during an election. But we will see the short-term rates eventually rise. I'll talk more about mortgage rates and the bond rates as we go through here. We're definitely seeing a plateau in property prices. So there's more, as prices have gone up around the country, people have put their properties, or some people have put their properties on the market, and that's result in more supply. And I think combined with a bit of fear from the war and rising interest rates, it's taken the heat out. So definitely feeling that. The figures come out later, but just from talking to people all around the country, I think we're seeing a bit of a plateau, particularly Sydney, Melbourne, and particularly in areas that had a crazy boom for the last 3 years. Even here on the Sunshine Coast, I'm noticing definitely a plateau, and we might even see some slight falls earlier than predicted, and that would be normal. That's what happens in a cycle. So let's jump in, and the returns. When we look at the 1, the 3, and the 5-year returns, they're almost textbook returns that we would project for your plans, which is what we like to see. The 5-year returns 4, 6, 7, 8, 9, effectively 3, 4, 5, 7, 8, 8.5. The 1 year 3, 5, 8, 9, 10. So almost textbook returns that enable us to plan for your future with a high degree of accuracy. So very happy with that. But you'll notice the last 6 months, and I'll show you in a minute a slide on this, returns have been negative. And this is to the end of February. We've since seen a bit of a recovery, particularly in the Australian share market. And that's meant we're kind of flat for the year. But for the first 6 months, most portfolios are down, but they are still up. But we consider a healthy amount over the year. And that's just part of the price. Whenever we experience one of these negatives, we're just reminded that it's inevitable, it's unpredictable, and it's the price we pay for superior long-term returns. It works in the long run for all the reasons we talk about, which I'll repeat again. But here's sort of the last 3 months, and you'll see the downturn. The blue line here is US shares, the black line is Aussie shares, and this goes right up to the minute. You'll see there's a vertical line here at the end of Feb, which is where my numbers are for today. So at that stage, the Aussie market was down 4.85%. US was down about nearly 10. And as we speak, right now, the Aussie market's recovered. So it's flat for the year so far, whereas US shares are down 8.73%. Now, Aussie dollar's up a little bit, so that contributes to some of that. So in reality, the US market's down about 5%, but quite a healthy little correction. And we'll see what happens from here. I just want to repeat this slide from last month. It does show in geopolitical events what happens to the share market, both in the initial period and then 6 months later and 1 year later. And so far, as you saw from that previous slide, this one's playing out kind of the same. An initial downturn somewhere up to 5%, but then down the track, normal returns, barring what else is going on in the world. Obviously, 1974, there was a lot going on in the world separately, and not saying this is exactly what's going to happen, but we tend to sort of forget about, we see the economic figures marching through and realize we're not changing our spending. Businesses are doing okay. Some are doing better than others. Absolutely horrible watching the war play out locally, but it doesn't have a big impact except for that horror on our own economies for now. And obviously it could get worse. So our model is always the boom, bust, wall of worry. We're quite firmly in the wall of worry. We've got the market at fair value. We're very comfortable that with the correction back down, that shares a reasonable value. That means you can make rational decisions whether you're buying or selling without worrying too much. Now, it feels hard, and that's why we call it the wall of worry, because whenever we're in that position, and you'll see throughout history, we go through long periods where the market wobbles up the hill, wobbles up that wall of worry. Eventually it booms, followed by a bust, followed by a quick rebound, and then back into the wall of worry. We're quite clearly in that at the moment. I won't dwell on this except to say we're very much fairly in the middle. Lots of worry about lots of things, but the economic figures and the profit figures that I talked about last month continuing to justify share values reasonably well. So I'm going to talk about another behavioral bias. And these are the biases. This is the human error. All economic theory is based on the rational investor theory, that investors are rational. Now, I've been an investor myself and helping investors for a long time, and there isn't one rational investor. We all are guilty of these biases. It's why for us, as part of our care investment committee, it's so important to keep reminding ourselves of these biases. And hindsight bias is the one for this month. And it's the bias that makes everyone say after an event that they knew it was coming. So after a GFC, everyone goes, oh, I knew that was coming. And the reality is very few people did, and very few people acted on it in their portfolios. I'm talking about professionals here. I'm talking about others. There are many people who panic or get fearful every time there's a hint of fear, but they do it 10 times in a decade. There's very few people that accurately predict what happens in a COVID, in a GFC, in a 1987 event. Not just once at the start of it, but also when you get in after it. But there's many who claim they predicted it afterwards, and there's just no evidence whatsoever. So one to be wary of. Now, back to interest rates. And this is the yield curve. So it shows interest rates on the left-hand side and maturity right up to 30 years. Now, the 10-year bond rate's the one we talk about a lot. It's the most common one. And in Australia, that's up around 2.8%. But 1 month ago, it was only about 2.2, 2.3. So in 1 month, we've jumped 0.6%. That's substantial, but it's still, and the bond deal is the best prediction that we have on inflation and interest rates as well. So it's still, and you'll see in the US the same thing, but at the longer end in the States, it's starting to narrow back down. So this is telling us that the bond market, one of the biggest financial markets in the world, is effectively saying they think inflation is not permanent. It's not going to get let out of the bag. That's no guarantee, of course, but it's certainly a little bit of comfort. And I showed this last month, but I wanted to show it again just to emphasize. People tend to think because the last time they remember inflation, which is in the 70s and the 80s, and we had rising interest rates in the 70s and the 80s, that's what's going to happen. So what we've got at the bottom chart here is interest rates, and the top we've got inflation. And you'll see for the last 42 years, we had inflation and interest rates both coming down, and we had interest rates going up in the lead up to that. So everyone at the moment is paranoid about inflation's coming because, interest rate rises are coming because inflation is stuck its head up again. This is the US numbers. But you've only got to go back to the 1940s, the 1950s, when we had several spikes in inflation that proved to be short term, and that had no impact on long-term interest rates at all, including mortgage rates. So there's not a link. They are definitely related, and sometimes they'll move together, but there is not a direct link. And it's not to say any one of us know exactly what happens this time. The key things to watch, though, are if we start to get massive wage increases in particular, and at the moment it doesn't look like that's going to happen. There are sectors that have massive wage pressure at the moment, but as the borders open up, they will be relieved somewhat. So it's very interesting to watch. I'll show what impact this had on mortgage rates in a minute. And that's the big fear for lots of you with mortgages. And of course, for retirees, a little bit of interest rates. You don't worry too much. All of a sudden, you can get a bit more in your bank accounts, your term deposits, and the reserves that we keep. So jury's still out there. Our thesis has been we're returning back to pre-COVID normals. The war, the supply chain stuff and the war may continue to exacerbate the supply chain issues. So we may see inflation in there for a while, but at this stage, we're not seeing it launch into interest rates. We're just seeing interest rates return to a kind of pre-COVID normal. So I'm not going to go through this, but needless to say, the media is still having their best time ever. They've never had a war plus COVID. We've got inflation, interest rates, so don't let them scare you. Look at long-term views and look at your plans. We know that the best investment decisions are best made as part of a plan, and part of those pillars there is understanding why most people mess it up. We've certainly got some of those single issues at the moment. We go back and learn from history regularly, and we've been talking about the different investor behaviors, because we know that if you avoid making bad decisions and you invest well through good portfolio construction, you will achieve your planning goals. And many of you have seen that through the ups and the downs, and there's nothing to think that won't continue. Let's have a look at the markets now. Now, keep in mind, it's March 28th. I speak this. The numbers released here are for February. So February was actually up in Australia. It was down for most other markets, but you can see here's the dot of where we were at the end of February. We're up substantially in Australia since then. The Australian markets run up very well on the back of those good economic numbers, on the back of our commodities, particularly iron ore and things like that, which we compete well with. We do have an oil and gas industry, etc., which will do well out of the rising prices. Hurts the rest of us, and it would be remiss of me not to remark that rising petrol prices is a brake on the economy. It does the same thing that interest rates going up do. It takes money out of our pocket that we can't use for other spending. So as much as we've got a lot of good going on, that is one of the handbrakes on the economy. And I just want to flow through diversification as we go through that. When you look at the historical performance of Aussie shares over 1, 3, 5, 10, 30, it's beautifully boring. And obviously we're going to have some swings around. But if you look at what makes up the ASX 200, there's about 300 stocks that make that up. And the top 10 makes up 46% of that. BHP now makes up 11%, then you got CBA, etc. And you'll see the difference in certain things. So BHP are doing well, and Australia has both the banks and the resources doing well. Now, when Australia has both the banks and resources doing well, because of their dominance, it means we have a good share market. And that's what you've seen in the outperformance of the Australian share market this year, but particularly in the last 3 months. Rising interest rates are good for banks. They get a bit of margin increase. And the rising commodity prices are good for the BHPs, the Rio Tintos, etc. So, good results there. US shares, different story. Look at that, the opposite way. Even since the end of February, market's gone down. And that's partly Aussie dollar going up, but partly the continuing correction over there, which looks like it's bottoming to a degree. The markets have actually bottomed over there, but whenever our Aussie dollar goes up, we do take a bit of a haircut. We don't make as much return on our US shares as our US investors do. That's US direct, but it acts as a brilliant hedge whenever the world has gone crazy and all those big downturns, almost simultaneously the Aussie dollar collapses, which acts as a buffer on US share drops. So the Aussie dollar generally helps us out on the volatility of US shares. And just have a look at the diversification we get here. In the US share market, the S&P, here there's 4,000 holdings. Now, dominated at the top, but not as crazy as Australia. In Australia, 45% in the top 10. In the US, it's only 24%. So we see and these are big companies too: Apple, Microsoft, Amazon, Tesla, Facebook, Berkshire Hathaway, Warren Buffett's company, etc. But not as big. The maximum there, Apple, is only 5.8% of this particular US share portfolio, whereas BHP is 11% of an Australian share portfolio. And look at the difference in results in US shares. So the tech that is solid, that has cash flow, Apple, Microsoft, except in particular, and Google have good double-digit returns. We've seen Facebook go back about 20%, Amazon back to about 8%. So at the hardcore end, a lot of small and emerging tech is back about 50%. So a healthy correction in the US tech space. If we go to US small caps, which covers some of that, it's had a, it's now back into the fair value zone when it returns similar to the Aussie, and it's quite similar in many ways to the Aussie market here, but it's recovered well, and it's a good sign that smaller cap. Keep in mind, some of these smaller cap companies would be in Australia's top 50, but they're small cap relative to the US. Down for February, but recovered since there, which is a very good sign. A couple of energy companies in there. So you see Southwestern Energy, which is a bit of oil. You see that up 52%. Matador Resources up 141%. So anything with resources and oil has had a bit of a spike. And you'll see that again in our global leaders, where you've got ExxonMobil joins into the top 10 and up about 57% for the year, purely on the back of rising oil prices. And this is the beautiful diversification you have in your portfolio. Whenever you see something going on a run, whether it be oil or gold, you can rest comfortably knowing you've got some of that in the portfolio, because the portfolios are beautifully diversified. Same story here, but this is similar to the US shares. This market down since the end of the month as well. But look at that beautiful 5 years of steady growth there, and 17% over the last 10 years for those global leaders, driven a lot by the Apple, Microsoft, Amazon, Facebook, Google brigade. Emerging markets. Now, this is fascinating at the moment, because emerging markets includes Russia, which is obviously the share market down about 25%, includes China, whose share market is also down because of more interference from the Chinese government. So we call this sovereign risk, where there's a risk of the government doing silly things to private enterprise. So we've seen them interfere in a few companies, and that's been companies like Alibaba. And have a look in this top 10 holdings. See Alibaba here, that makes up 3% of the emerging markets index. It's down 50%. Tencent, which is a Chinese digital company, it's down 42%. So they're down because of that realization that we still have sovereign risk with China. That is, there's still a risk the Chinese government will interfere with companies. So that's taken the sting out. Now, for the very brave, it possibly represents a buying opportunity, but at the moment, it would be a speculative opportunity. We'll see how this plays out. Emerging markets also includes Brazil. So you can see Vale, the iron ore producer from Brazil, also in this. And it also includes India, which is growing particularly well, and amongst other emerging markets around the world, including Korea. So Samsung in there, down a little, but you see some big ups as well. So yeah, interesting. We just keep rebalancing throughout this. Emerging markets is only a minor spot in all the portfolios because it does have a higher risk reward. We expect to get good returns in the long run, but more volatility in the short term. So potentially cheap right now, one for the brave. We'll just be rebalancing throughout this and not speculating. And look at gold, spiked up massively as the war started, but it's backed off. So what does that tell us? That means the markets around the world are not that worried about the war's impact on the broader world economy and the share markets. Now, whether that's right or wrong will remain to be seen, but I've learned not to fight the market too much. People that say, oh, the market's wrong, the market is what it is. It reports all the best knowledge right up to the minute. So gold back a little bit, still a massively important part of the portfolio. In the last year, it's delivered returns of 16%. So that makes up for some of the portfolios. While the emerging markets lost 5%, gold has helped protect that in the active portfolio. But I get asked occasionally why we don't have more in gold, and that's because in the long run, its long-term historical average is not that high. It's only about 5%. It can be highly volatile. Once it goes on a run, it goes on a run. We like having it in the portfolio for all these reasons we talk about here. It's a currency hedge. It's insurance when there's a lot of risk in the world, and you'll see it bounce up. We saw it bounce up during COVID, and we've seen it bounce up again during the war. So it's a nice little insurance policy to have in the portfolio. Let me talk about property a little bit, and I always like to start with property goes through cycles, and every state and every city and every town can be in their own cycle. Beware of forecasts, including mine. You see the banks say precisely, we're gonna moderate the growth this year, and then it might fall by 4% next year. I've seen other bank economists talk up to 10%. We can definitely feel the plateau occurring, certainly in Sydney, certainly in Noosa and the Sunshine Coast. So I do feel we're at a plateau stage, We may have a slight downturn, we may not. The wild card here, two wild cards, interest rates and immigration. So, interest rates affect the cost of owning property. And you can see what we've got here. This is the fixed rate mortgages in Australia, and they're pretty much back to where they were in late 2019, which is pre-COVID. So we're now back to that kind of normal range. Not quite at the 1 year, not quite at the 2 year, but 5 year rates are now getting up there to where they were, as are 4 and as are 3. So this is telling us we're now getting back to a more normal market. These are still incredibly low rates when you look at the last 20 years. But for someone who's borrowed at 2% and all of a sudden faced with 4%, it's obviously an increase in the mortgage repayment. But this will apply some headwinds to the property market, but not crazy. Variable rates are still in the 2s and just starting to nudge up towards the 3s. But once again, historically long term. This is what property prices have done in the last year. So you can see in the red column here, Sydney 25%, Melbourne 15%, Brisbane including Gold Coast 33%, Adelaide 28%, Perth only 8%. Then we've got Brisbane at 32%, Canberra at 25%, Hobart at 25%. These are solid gains. But we're seeing the monthly figures. We see Sydney and Melbourne have flattened, and this is to the end of February. And obviously, there's a lot of stuff I'm hearing says we're plateauing a bit more, but the markets are all on a different cycle. Units not quite as high, except for Hobart. So, as we get immigration come back into the cities, we might see a bit of that the units may do better than houses temporarily as it brings them back to normal. This is interesting. This long-term chart I've been showing lately, it shows the different cycles with everything back to the same effective starting price in 2012 or 11-12, and then what's happened since, with Sydney being quite clearly on top, followed by Hobart, followed by Melbourne, and then right down the bottom, Darwin done nothing for 10 years, slightly under. Perth just nudging up. And I was talking with some of my Perth colleagues at the conference. They said, everyone in Perth's a bit worried. The market's up a bit, but it's back to where it was in 2013. And if you have a look in the last quarter, and this is from the Australian Bureau of Statistics, so their data is the slowest, but it's the most accurate. So this is data to the end of December, and this is for the quarter. So Brisbane up 10% in the last quarter. We certainly saw that. Gold Coast, Sunshine Coast as well. Darwin flat. Sydney and Melbourne are still going strong, but as we just saw, they're slowing down. So I think we're plateauing. Very much get advice around if you've got any particular decisions you need to make about buying and selling. And for anyone who's new to the market, we're being very careful about where we buy. There are some cities like Perth and Adelaide. They're in a very different place in the cycle right now. And anyway, talk to us if you've got a decision to make about property, either selling to set up retirement or buying to fund a long-term investment. And probably still going to be a great long-term investment. Our friends at Harron Todd White, I'm going to be fascinated to see next month to see if they start to move anyone across to the starting to decline section. At the moment, we've got everything on the left-hand side of the clock, which means everything's rising or approaching the peak of the market. I want to share with you before I wrap up population forecast and show sort of what population numbers have done in the last few years. There's some actuals, but we've seen Australian population stagnate in the last few years. We've been stuck at about 25.7 million, and that's because we just stopped the net overseas migration. Normally, in the lead up to this, net overseas migration is between 200,000 and 300,000 people. That's been negative for the last 2 years. Slight recovery expected this year. These are forecasts. And then this is the Australian Government Centre for Population. Then they project it will go back to 2 to 250,000 beyond that. Now, they obviously have a wide variety of projections, but this is their base case. Australia's natural increase is very steady, but effectively it means between net immigration and natural increase, we've got 3 to 350,000 of new people every year that need housing. You've also got changes in housing formation. So that means things like the fact that there's less average people per household than there's ever been. Once upon a time in Australia, there was 4 people in every house. It's now 2 point something. I'll see if I can get some numbers for next month. But we've also got a lot of people that might have 2 houses, particularly some of the affluent retirees. They'll have 2 or even 3 houses. And we're seeing lots of changes here. So, and then I'm going to finish with a projection from one of Australia's demographers, McGregor. And this shows what population is going to do by capital city between now and, well, back from 2014 to 2034 and 2054. So, at the moment, Sydney and Melbourne are about 5 million people, give or take. Melbourne will go past Sydney somewhere in the next sort of 10 to 15 years. And Sydney and Melbourne are going to have 8 million people. So that'll be the size of New York, roughly. So these are going to be big cities. That's an increase of 3 million people. That's a whole lot of housing needs. So, the property market still has some tailwinds in terms of that sort of stuff. Have a look at Perth. Perth in 2054 will be the same size as Sydney and Melbourne are now. Quite amazing when it's, it's coming off that 2 million sort of thing. Now, this only shows Brisbane in this numbers, but if you add the rest of southeast Queensland, predominantly Sunshine Coast, Toowoomba, Ipswich, and Brisbane, that number starts to get up about 7 million as well. So that southeast corner of Queensland, like it or hate it, will get up to similar size to Melbourne, Sydney. So very strong tailwind from property from those sort of numbers, headwind from interest rates. But I suspect we'll be flat for a little while, except in places that have been flat for a fair while. Once again, talk to us if you need to. Thank you for listening and just reinforcing our process there. That all investing is best done as part of a real plan. It's based on goals and based on your life and what's important to you. Portfolio designed to meet that. And the portfolio is designed to get those long-term returns, which they're doing well. We take a long-term view. We don't jump at shadows of all the things that are going on at the moment. We get back to the basics of diversification, asset allocation, and having enough liquidity to ride through markets. And we access the markets with low-cost index funds for most. And we rebalance regularly. What the rebalancing means is in a month like this, where Aussie shares have gone up and international shares have gone down, we'll sell a little bit of that Aussie shares at a profit and buy a little bit of the international. That's only a little bit, but that the academic evidence on rebalancing shows that good rebalancing adds anywhere from 0.3 to 1% over a year and rebalancing. I repeat, as I always do, sorry to be a broken record, but this is probably the most important thing investing. There is only 3 ways to lose money in the share market. That's panic and sell, have to sell because you need the money, not properly diversified. That's why it's so important to have a good plan and so important to have adequate reserves for those that are retired. Thank you so much. I hope you're enjoying life, and I got through this without coughing. So that tells you how not severe my COVID symptoms are. But I know others are coping it more. I know Jodie's worse off than I am. Until next month, and look forward to catching you all in the office at some stage soon.